On this right now, William Lee, chief economist at Milken Institute, serious tours of duty with IMF. Dr. Lee, thank you so much for joining this morning. Why does the bond market matter to people like you?
It really determines how it is that monetary policy affects the real economy. It's the bond market that's the key to the transmission channel of monetary policy. And I think one thing that we should be concerned about is that even though the IMF delegates were not concerned about the bond market, the Federal Reserve seems to be overly concerned about the bond market if they start talking about letting the bond market do monetary policy. The bond market's not the central bank of the United States.
Joyce Chang at JP Morgan made the distinction off of Barry Eichengreen's paper at Jackson Hole that this will have serious big country effect on EM. Do you agree that the future of, say, the Pacific Rim or broader Africa is affected by Jerome Powell?
You got it, Tom. When the dollar's strong, it starts to suck in capital from the rest of the world. And that's exactly, in some ways, the opposite direction that capital should be going, from capital scarce to capital rich countries. Now, granted, the United States is where productivity is highest, it's where innovation is greatest, and you can justify why it is that people want to invest in the United States. But to suck out even more capital from the emerging markets that need the capital, that's a problem.
But we need to dig into the bond market. When the Federal Reserve starts to allude to the idea they're willing to allow the bond market to do the work for them, it's a very specific part of the bond market. It's not the front end, it's not short rates, it's long rates. It's the 10-year and out. And that's where we're seeing all the volatility. Bill, can you talk to me about the effectiveness of that? Shifting the emphasis away from short-term rates to long rates in fixed income.
The usual transmission channel is that the short rates will influence the long rates, and it's really how it influences the long rate that allows the economists to try to forecast what monetary policy is going to do in terms of applying the necessary restraint. It's the long-term interest rates that are in the cost of capital. It's the long-term interest rates that affect the valuation of equities. So it's absolutely critical. But right now, what we're seeing is a rise in the term premium, and also, in some sense, a lack of credibility on the part of the Fed, and signaled by the fact that five-year inflation rates, very long-term inflation rates in the 10-year horizon, are starting to rise. And why is that? It's because people don't believe the Fed is going to take seriously its 2% target of inflation targeting.
So, Bill, do you find it odd that they're willing to outsource monetary policy to long rates without a firm, solid understanding of what's underpinning the move higher in long rates?
Well, it's a consequence of this, well, let the data determine what I'll be doing, and I don't know what I'll be doing until I see the data. This allowing the data to wag the monetary policy is absolutely the biggest mistake you can have. The Fed has always been objective driven. It always had policy targeting, whether it's intermediate targeting like money or interest rates, or final targeting like inflation or unemployment, or both. But right now, to say that, gee, I am going to let the data determine what I'm going to do, and I won't know what I'm going to do until I see the data, that's nuts. And that means we have unanchored bond markets. And when the bond market's unanchored, it's going to be doing whatever it feels like. It's going to go up one week, it's going to go down another week. In fact, it can do it all within 1 week.
And that's what we have been seeing over the past few weeks, Bill. I am curious, though, given your study of the flow of money internationally, of some of the whys behind the volatility in the bond market, the rise in the long end of the yield curve. We were speaking with Dalip Singh of PGIM Fixed Income, and he was saying this is due to a lack of price-insensitive buyers in China, in Japan, from Asia. Do you buy into that? Do you think that that is underpinning why you have had an unanchored longer-term bond yield?
A lot of the capital flows are, in some sense, price insensitive because they're very strategic right now. China's at the heart of all this. I just got back from a month in Asia, South Korea, Singapore, and Taiwan. And I got to tell you, everyone I talk to has got China on their mind and trying to develop a strategy as to where I should park my money if I'm going to be taking it outside of China. And right now, in fact, people are being strategic and saying, let me start to use the political tensions that the U.S. and China are having by saying, let's add more U.S. content. Mexico has become a haven for a lot of strategic capital. To plug one of our Milken Institute reports that just came out, Mexico as a strategic partner is a report that my colleague Maggie Switek just put out, and it's worth reading because it tells you Mexico, imports from Mexico have now exceeded the level of imports from China. That's how important finding alternatives is right now, and that's determining a lot of the capital flows.
But you're talking about going into places that might benefit from China being de-emphasized as a trade partner. What about China itself as a buyer of U.S. treasuries? What about some of these other investors as potentially seeing U.S. government debt as an option?
China's not much in a position to do much as a source of growth for the world. It's not doing much except the fact that it has continual surpluses with the United States in terms of buying up our treasuries. In fact, China is going out of its way to try to diversify its reserves and go to euros and something else, even cryptocurrencies, in order to reduce the dominance of the dollar in the international monetary system. So it's not going to be behind the buying of treasuries going forward.
Hey, Bill, wonderful to get your perspective. It always is. Bill Lee there of the Milken Institute on the latest on the deficit, the bond market, Fed policy, and China. This is the latest from Stuart Carr.